everyone, my name is Vaibhav Puranik and today we are going to talk about capital stack in a typical multifamily syndication. We're going to understand what a capital stack is, what is it made up of, and we're going to go in depth about the components of capital stack. Sometimes the word capital stack confuses beginner investors because it feels jargony, right? But its definition is very simple. The definition is where is the money coming from and the breakdown of its various components. That's it. Okay. So where is the capital coming from to buy this multifamily? In general, in a typical multifamily syndication, the capital stack is made up of two kinds of capital financing. One is debt, other is equity. Debt means loan, as simple as that, right? And equity means the shareholders, the people, the investors like you who are putting your money in, right? Now, debt consists of the bigger portion usually, right? And that's the same as your single family home as well, right? In a single family home, when you, let's say you're buying a house for $1 million, and out of that, the bank requires you to pay 20% down. So you are putting $200,000 of yours, and $800,000 of it is going to come from the bank, right? So what is bigger here? The loan is bigger, right? The bank put more money than you, right? And your equity here is $200,000, only 20%, right? Now the interesting thing here is, a lot of people don't understand that debt, sometimes also referred as a leverage, is actually a very good thing. And the reason it's a good thing is it increases investor return. Let's understand how. Let's say you have $100,000, okay? And the homes in your area are available for $100,000. So you go in, you pay $100,000 cash and buy a house. 1 year passes. This house has appreciated 20%. Okay, just for an example. So the home is now $120,000 worth. You sold it off. You got $120,000 back. Your return is 20%. Simple. Now let's say an alternate scenario in which you have $100,000, but you chose to do something different. Instead of buying one house, you buy 5 houses by putting $20,000 down and taking $80,000 loan, right? Just like earlier example, on each of those houses. So the same capital, same amount of capital, but you were able to buy more number of houses, correct? 1 year passes. Each of these homes are around sold at $120,000, just the same as our earlier example. Okay. So now what happens? You have to pay back banks $80,000, right? So on $20,000 capital for each home, you're going to get $20,000 back extra, correct? So you get $40,000 back totally. So then on $100,000 for 5 homes, you get another $100,000 back, correct? So what is your return? 100%. Now, smarter investors will say, well, you paid the interest for 1 year. All right, reduce it a little bit, right? Even if the 100% goes to like 80%, 70%, even 60%, it's still way better than the 20% you got on all cash deal, right? That's why debt is always good for investors, right? Debt increases the investor return. So first of all, understand this. That is why almost all multifamily deals will always have debt. If it is an all cash deal, you might have a peace of mind, but you're going to suffer in return significantly. And that's because your base remains higher, right? That's the problem. Now, so imagine a Maslow's hierarchy like a triangle, right? And in that triangle, debt is at the bottom. It's bigger, okay? Bigger portion. And also, now the bank who puts in more money also expects a different treatment than the investors or equity side, right? What they say is that when the property gets sold, you need to pay back my loan first and then pay to your investors, correct? So its risk is different, correct? So let's say the property doesn't appreciate at all. $100,000 property remains 100,000 in 1 year, and for some circumstances you have to sell it. In that case, the investors are not going to get anything, zero return, correct? Because they paid 20,000 and they got 100,000 back. Out of that 80,000, they have to pay back to the bank, and they got their $20,000 back, right? But the bank got its own money back, and bank also got 1 year of interest, right? So your actually investor return might be even lower. So debt gets paid first. That is very important topic, very important thing you need to know about this. There are various kinds of debt, right? Just like a single family, it's not as simple as single family where you have one bank loan. There could be multiple types of loans, right? Usually, the biggest loan or the bank loan that on a multifamily property is called senior debt, right? And this is in the topmost in the hierarchy of getting paid. So senior debt gets paid the first. Then you could have a mezz debt, or sometimes also called junior debt, right? And these are other loans, that second loans that you have taken, maybe bridge financing or some other kind of financing, right, that you have, or even simply a loan advancement that general partners have made themselves, right, to do a capital project or something, right? So those loans come later, right? So first you have senior debt, then comes all sorts of other debt in terms of payment, right, repayment, in terms of senior debt, the junior debt, and then you come maybe the GP debt, some sort of. So different kinds of debt get paid in different order, but usually all the debt gets paid first, and then equity investors get paid. Now, some interesting things to know about debt in a multifamily is multifamily debt usually have floating point rate, right? It's not 30-year fix like you have in single family, right? And another interesting thing is that there's a prepayment penalty, almost always a prepayment penalty. Okay, so let's say there's a 5-year fixed period, and then they'll say that if you paid below 5 years, there's a step down penalty. That means 5% on first year, 4% on second year, 3% on third year, 2% on fourth year, and 1% on fifth year. So step down penalty, right? There is also another kind of penalty called yield maintenance. It's kind of a little bit complex to calculate, but it's basically ensures that the bank is not losing any money, right, on interest. So those are the kind of penalties that are there. So when you are evaluating a multifamily syndication, right, when you ask a question like what is capital stack, like how much is the debt, you need to ask these questions, right? What is the floating point rate? What is the fixed period of that floating point rate? What are the prepayment penalties? What is the loan to value ratio, right? How much percentage is bank giving actually? And what are the lender conditions? Like there could be lender who can put conditions such as, oh, you have to have a property occupied 95%, or those kind of things. So you have to know what those lender, as a passive investor, you need to at least know these things, right? You need to make sure that the general partners have done their homework and they should be able to answer your questions properly, right? Now let's come to the equity side of the things, right? So you saw what the debt is. Actually, there's one hybrid thing between debt and equity, and it's called preferred equity. Okay, preferred equity. Now, what preferred equity is kind of hybrid. It's neither a debt nor an equity, right? It gets paid after all the debt gets paid. Okay, but then they have a fixed return, like 8 to 12%, right? It's fixed return, so they don't get the upside of it, correct? So you won't see it every time in multifamily syndications. Definitely not on a smaller syndications, but these are sometimes large institutional investors that come in, give money as debt in a way, but they want to make sure they don't want to assume the same risk as common investors, right? So that's preferred equity. And then at the end comes common investors, right? Which is the equity. Now, these are the people who are like you, who is putting their money to invest in a multifamily, and these people are get paid at the end only if there's a profit, right? So if bank loan gets paid first, preferred equity gets first, and then if there's a money left, then you get paid or the investors get paid, right? Now, assuming the property is profitable, then you're going to get some money back, right? Now, within that also there is a hierarchy, because there could be several classes of equity investors, right? Class A, Class B, sometimes they got gold, platinum, like every general partner does it differently, right? And each the risk is different, because for example, certain Class A might require you to put at least $100,000, and then you will get paid first before other people, right? Or you might get paid even higher return, right? And additional, you might get more, 2 percentage point more than other people, right? So that's possible. So when you are doing your due diligence, when you are investing, you need to read the PPM really carefully and understand what class are you, right? And what is the order in which you are going to get paid. This is the one most important thing you need to understand before you invest your money in a multifamily syndication, right? So that's it. I mean, if you want a more in-depth discussion on this topic, I'm actually writing a book, and the book will come out in like maybe, I don't know, somewhere around April, May of 2026. So you can wait for that. Or also, there's a ton of information on internet. There's a ton of information on our website, oldmoneycapital.com. So please visit our website, oldmoneycapital.com. Right? We have a podcast that is pretty interesting, in which we talk about different topics than the YouTube video, right? And we also have Instagram thing, and our handle is oldmoneycapital123, right? And we also have a LinkedIn profile. You can go to my LinkedIn profile, or we have a Old Money Capital's LinkedIn page. We have LinkedIn articles, right? So you can find us through all of these different channels. Okay. Thank you very much for listening to me, and we will meet soon with a different educational topic about multifamily syndications. Thanks.